Hello everyone, welcome. Great to have you here today.
Hello.
So today's show is going to be very topical. We're going to be discussing income generation. So I was thinking, David, we'll start with you.
I think the big issue around income is that the traditional forms of income that you get, which is effectively bonds, fixed income securities, are looking, how can we say it, less than attractive, I think would be a polite way of putting it. Which is not to say that they're a terrible investment, because frankly, if you can get, 3 or 4%, or in retail bonds, you can get 5 or 6% from lending to what sounds like a reasonably decent company, for instance, over a 5-year period or 4 or 5 year period. That's not a disaster. If you get your money back, you get 4 or 5% a year, maybe 3% a year. That's a damn sight better than what you might get elsewhere. But the problem is it's hard to argue that investing in bonds at the moment represents great value. And that, I think, leads people inexorably towards equities. Maybe we'll talk a bit about it in a minute. And dividends, for instance. Dividends are a good source, and I can't remember what the yield on the FTSE 100 is, but I'm guessing it's about 3.5%, something like that. Yeah. And that's not bad when you think about it. But I think that investors might want to think a little bit more laterally and search out new income opportunities. Because there is stuff out there. So, for instance, I've mentioned before things like there's a lot of asset-backed finance stuff where they buy planes, for instance, where you can get yields up to 8%. That you can do high-yield junk bonds, and everybody thinks when they hear high-yield junk bonds, they think they're junk and they're rubbish. But actually, they can be all right as long as you're not in the middle of a recession. They can get 9-10%. So I think, and there are other areas that you can look at. Commercial real estate, maybe we'll talk about that as well. There's lots of stuff, and they can give you, 4, 5, 6% a year. And so I think the key thing is to diversify, not just have all your money if you're looking for income in fixed income securities, or just in, big blue chip stocks that pay out decent yields, because they could stop those yields tomorrow.
So Troy, what do you think as far as income generation?
It sounds a bit complicated to me. I mean, there's two ways I'd maybe go. One of them might not be right, which is Mediterranean government bonds, or something for high yields.
Greece, Malta, Portugal, Malta, Sicily, Gibraltar,
I hear they're paying
Greece is on the Mediterranean. Yeah.
They're paying quite a lot, aren't they? But for me, it would probably just be dividends. Something like banks. Pay a dividend for me, so I'd just be able to gain some money from that, and it maybe wouldn't be as best as I could get as regards to interest rates, etc.
Actually, Troy raises an interesting point there about, you say Mediterranean, but if you think of things like Italy,
Spain,
in Spain, where there's a judgment there and there's a risk, certainly, which is why you're getting a high yield. The question is whether we're talking about people who are seeking income because they want to reduce risk, and there's an issue there, because I think
that the problem is if, for instance, if you look at it, I'm not convinced that even that those Mediterraneans, we put it, are worth the effort. So let's look at things like Italian or Spanish bonds, for instance. If you lend to those governments for 10 years, at the moment you'll still be lucky to get, I don't know what the rates are, but 5, less than that, I think 5. Yeah. And my view is that I'm not saying that I think you'll lose your money for those things. I don't, because I don't think you'll lose your money.
Return,
I just don't think it's. I think you can get a better return for less risk. Exactly.
What do you think about the overall trend of investors' confidence in the equity space, moving a general trend of investment from the bond space back into equities, particularly over the last year? Does that make it more attractive?
There's two things here.
To go into bonds?
There's money moving from bonds into equities, and then within equities there's money moving perhaps from the defensives into the more exotic.
And I'd add a third thing. There's quite a lot of money which was in cash. I wasn't in equity or bonds, and has gone into equities. Yeah. So, and I think that what happened initially was it was cash into equities. And then I think there was some move from more defensive stuff like utilities companies,
which give you good yields,
very good yields, through to more adventurous kind of stocks. And then I think the thing that started most recently is you've seen a lot of people selling down, but not a lot, but more people selling down their bond funds to buy equity funds. And I suppose the argument is, look, do I think that equities are, or income-oriented equities are more attractive than cash? Probably yes, and they certainly were a year ago. Do I think that it might be time to take on some more risk now? Probably. And do I think it's probably, and that's going back to what I said earlier, do I think that bonds represent compelling value? No, and therefore, you might take some of your profit on bonds and put it back in shares.
If you didn't want to go as far as bonds, of course, one asset class that's often overlooked is the preference shares, not simply with banks. And and of course you have the equity risk there, not quite the risk of the ordinary shares, but actually many of them have outperformed the ordinary shares in terms of capital, but you get that.
And actually on that thing, what some of you may be quite interested in, if you want that mixture of income, caution, and some growth, is you're seeing the rise a lot more of people investing in convertibles, and they're not dissimilar from preference.
They're not dissimilar at all.
And they're an interesting idea because actually, effectively, what you do is you get the bond component, regular income, not as much as a typical bond. So instead of saying 5%, you might get 2.5%, but you also get effective in options. So the shares carry on doing that; they can turn into shares. So in America, they're a very conventional way of having a sideways bet on the equity markets.
All right, gentlemen, those are some terrific ideas in there. I look forward to generating a lot of income. Thank you so much. We'll see you next episode.
Cheers.